Good afternoon. I'm Erin Campbell, Commissioner of Minnesota Management and Budget. I'm joined today by State Economist Dr. Kalambokidis and State Budget Director Ahna Minge to present the November 2023 Budget and Economic Forecast. Our twice-a-year forecasts are efforts to predict what lies ahead. We analyze many data points in developing our forecasts, and they represent the best financial projections we can provide based on the information available when we prepare them. I want to thank my colleagues at Minnesota Management and Budget, some of whom you will hear from in a few minutes, for their hard work and commitment in preparing this forecast. I also want to recognize staff from agencies throughout state government who provided the information necessary to create this forecast. Many economic and policy factors help drive forecast outlooks, and we'll talk about some of those factors today. Overall, I would characterize today's forecast outlook as mixed. For FY 24-25, we project a healthy general fund surplus of $2.4 billion, $808 million more than anticipated at the end of the most recent legislative session. Since our last forecast, the outlook for the U.S. economy in the near term has improved. This is driven by stronger than expected consumer spending, business investment, and employment. Turning to our revenue projections, we forecast increases in consumer spending and corporate profits. These increases will translate into higher tax revenues in the current biennium than what we had anticipated at session's end. However, state spending is also projected to be higher, driven largely by increased expenses related to health and human services and education, such as disability waivers, and increases in the number of pupils in Minnesota schools. In this forecast, spending is projected to outpace revenues in each fiscal year, creating a structural imbalance that depletes the bottom line. On top of the structural imbalance, you will recall that due to a statutory change, we now include the impact of inflation on the expenditure side of the equation. That adds to the gap between revenues and expenses you'll see in the coming slides. This slide shows the change in forecasted FY 24-25 budgetary balance in the middle column compared to the end of legislative session estimates in the left column. The column furthest to the right on the table shows the change between the end of session and this forecast. The bottom row of this chart shows the budgetary balance, which we are projecting in this forecast to be $2.4 billion for the current biennium. This is an increase of $808 million over the end of session estimates and is after an additional allocation of $61 million to the budget reserve. The biggest driver of this change is the $1 billion that has been added to our beginning balance for the FY 24-25 biennium. As you might have read in our first ever biennium budget close report for FY 22-23, we ended that biennium with a positive variance, which is then added to the beginning balance of the current biennium. In this forecast, revenues are also up for FY 24-25. In later slides, Dr. Kalambokidis will provide additional details about the higher consumer spending and corporate profit growth, which contributes to an increase of $837 million in revenue that we are forecasting. Expenditure estimates are also forecasted to increase $998 million in the current biennium, a majority of which are due to increased spending in health and human services and education spending, which State Budget Director Minge will detail later in our presentation. As you can see, this offsets the increased revenue projections in this biennium. The next line shows the balance in our cash flow account, which remains unchanged in this forecast. The line below that shows the change in the budget reserve, which now totals $2.9 billion. As a reminder, under existing statute, our budget reserve levels are recalculated every November forecast so that our reserve target remains adequate to manage the underlying risks in Minnesota's revenue system. Again, the budgetary balance for this biennium is projected to be $2.4 billion. This is a projected balance that will carry over into fiscal year 26-27 biennium if it is unspent this year. Normally, when we talk about the budget, we focus on the current biennium. Based on how our budget is structured, however, we also have to be concerned about the following budget years because each biennium impacts the next. So this slide focuses on fiscal years 26 and 27. For fiscal year 24-25, the projected balance of nearly $2.4 billion is shown in the dark blue bar on the left. That amount will carry over into fiscal years 26-27 if unspent. We expect baseline expenditures in fiscal years 26 and 27 will outpace revenues by more than $1.4 billion, as you can see in the light green bar on the left. When you add that to the $880 million in inflation to maintain the same level of services going forward, you get a total projected structural imbalance of just over $2.3 billion. That leaves a projected balance of only $82 million at the end of fiscal years 26 and 27. $82 million provides little cushion when you consider the size of our projected state budget. Such a small balance, together with a structural imbalance, suggests policymakers will need to be very thoughtful when making budget decisions this next year. So with that overview, I'd like to invite Minnesota State Economist, Dr. Laura Kalambokidis, to the podium to describe our economic and revenue outlook.
Thank you, Commissioner Campbell. I'm Laura Kalambokidis, Minnesota State Economist. I'll start with the outlook for the U.S. economy. I'll move to, and how that's changed since February. I'll move to Minnesota's labor market, and then turn to details of our new revenue forecast. Since Minnesota's budget and economic forecast was last prepared in February, U.S. real GDP has grown faster than forecast, driven by faster than expected growth in real consumer spending and business investment. This, along with unexpectedly strong employment growth, prompted S&P Global Market Intelligence, Minnesota's macroeconomic consulting firm, to raise their GDP outlook for 2023. Oh, my fault. For 2023. In this first chart, we're showing the S&P forecast for annual growth in U.S. real GDP. The light bars show the February forecast, and the dark bars show the history and the current forecast. S&P now expects real GDP to grow 2.4% this year. That's 1.7 percentage points faster than what they expected in February. And that was when S&P expected a mild recession in the first half of the year. This recession didn't materialize, and the BEA now estimates that real GDP grew in the first 2 quarters of this year. Long-term interest rates have risen higher than forecast in February, causing financial conditions to become more restrictive. In addition, largely due to the stronger economy, the Federal Reserve is expected to keep rates higher over the next couple of years than S&P forecast in February. That's the higher for longer narrative you've been hearing about regarding monetary policy. Consequently, S&P has reduced their growth expectations beyond 23. For 24 through 27, average annual real GDP growth is now expected to be 0.2 percentage points less than in the February baseline. So regarding the change in the U.S. outlook since February, an outperforming economy so far this year raises the near-term forecast, and tighter financial conditions lower the forecast in subsequent years. The next chart shows the forecast for annual growth in U.S. real GDP consumer spending. In real consumer spending, which has markedly improved. Spending has exhibited more resilience this year than expected in February, as the U.S. labor market has added jobs at a faster pace than predicted, and wage income has grown. S&P now expects real consumer spending to increase 2.3% in 23, 1.3 percentage points higher than in the February forecast. S&P expects spending to increase 1.9% in 24, 0.8 percentage points higher than in their February forecast. Similar to the forecast for real GDP, growth then decelerates in years 25 through 27, averaging 1.7% annually. This chart illustrates the forecast change for the dollar value or level of U.S. corporate profits. The dark line shows the history and the current forecast. The dashed line shows the February forecast. The level of profits is now expected to be higher throughout our forecast period compared to February. Note, however, that beginning in the third quarter of next year, S&P expects a period of corporate profit decline extending through mid-26, even while remaining above the level of the February forecast. On an annual basis, S&P expects corporate profits to grow 0.9% in 24, decline in 25 and 26, and resume growth in 27. Moving to Minnesota's labor market, this chart shows the official unemployment rate for Minnesota as the dark line and for the US as the light line. The state's labor market has eased somewhat from the record low unemployment rates and record high job vacancies that we experienced in the last 2 years. But unemployment in Minnesota remains low, with a rate of 3.2%, 0.7 percentage points below the US rate. At 68.5%, Minnesota's labor force participation rate is 5.8 percentage points above the US rate and is the fourth highest among US states. And as employers will tell you, we still have a strong demand for workers across the state, with more than 2 job openings per unemployed worker statewide. This chart shows total jobs in Minnesota starting at the end of the 07-08 recession, and I'm only showing you the top of the graph here, starting at about 2.6 million jobs. You can see the fairly steady job growth the state experienced during the 10 years of economic expansion, reaching around $2.9 million jobs, people, in February of 2020. You can see the job loss in the spring of 2020 with the start of the pandemic recession and the subsequent recovery. The state continues to add jobs, and in September, Minnesota's payroll employment surpassed its pre-pandemic level. Additional employment growth in October pushed the total number of jobs in the state to 3 million for the first time. Turning now to the revenue forecast. The first 2 columns of this table show our current forecast for the current biennium and the change from the end of session estimate. And the second 2 columns show the same thing for the next biennium. Total revenues for the current biennium are now forecast to be $837 million more than the end of session estimate. Individual income tax receipts are now expected to be $206 million more than the end of session estimate. Using current but preliminary information regarding tax year 22, which is the base year for this forecast, we have a lower starting point for the income tax forecast than we had in February. That lower starting point then carries forward to the rest of the forecast years. Technical adjustments, which on net raise the income tax forecast, more than offset that lower base year liability estimate. The sales tax is now forecast to generate $156 million more than the prior estimate. This is due to higher than expected net sales tax receipts so far in fiscal year 24 and the higher forecast for consumer spending I mentioned earlier. For the corporate tax, a higher base also from higher receipts so far this fiscal year and that higher expected corporate profit that I illustrated earlier raise our revenue projection by $250 million over the prior estimate. Total revenues for the next biennium are now forecast to be $30 million less than the prior estimate. Higher forecasts for sales tax, corporate tax, and other tax revenues offset a lower forecast for the individual income tax. Note that the pattern of corporate receipts lower in the next biennium than in the current biennium, even while we've raised both forecasts, follows that pattern of declining profits I mentioned earlier. And the income tax forecast for fiscal years 26 and 27, which we've now reduced from our prior estimate, reflects that lower base year liability and slower economic growth in the out years that I talked about earlier. Let me highlight some of the risks to the forecast. I haven't yet talked about inflation, which has moderated substantially this year. CPI inflation was 3.2% in October, 2.8 percentage points lower than February. The current baseline forecast assumes that the US economy slows, as I showed in that first chart, that the US unemployment rate rises and CPI inflation falls to 2.7% in 24 and an average of 2.2% per year in 25 through 27. S&P assumes the Fed will raise the federal funds rate in December, followed by a policy reversal or rate decrease in June of 24. If inflation persists above the projected level, the Fed may act more aggressively to raise rates than assumed in the baseline forecast. International events pose risks to this forecast. For example, worsening conflicts in Ukraine and the Middle East could lead to higher energy prices or the reemergence of supply chain issues, and other international risks, such as economic volatility in China, could disrupt the U.S. economic path. With 19 months remaining until the end of the 24-25 biennium, even small changes in assumed rates of growth in important income sources, including capital gains and corporate profits, can generate large changes in the outlook for this biennium. But even more, the difficulty of projecting long-range economic conditions and taxpayer responses to law changes warrants particular caution when using forecasts for 26 and 27. I'll now turn it over to State Budget Director Ahna Minge.
Thank you, Dr. Kalambokidis. Good afternoon, everyone. I'm Ahna Minge, State Budget Director with Minnesota Management and Budget. I'm going to walk through changes in the general fund expenditure forecast and then turn it back to Commissioner Campbell, who will go over our long-term budget outlook. This chart lays out projected general fund spending in both the current biennium and the next by major programmatic area. It also includes a column for each biennium outlining changes from our previous estimates. So our previous estimates were those we made at the end of session. They included both the February forecast, but then added on enacted changes by the 2023 legislature. I'd like to first draw your attention to the very bottom line of the slide, total general fund spending. In the current biennium, we project total general fund spending will be $70.5 billion, a $998 million increase from end of session estimates. In the next biennium, the planning years, we project the general fund budget to be $66.2 billion, an increase of $982 million from end of session estimates. It is a little unusual to see a decline of that magnitude from biennium to biennium, and we'll talk about what's going on there a little more later in my presentation. But let's talk about what's driving this expenditure change. If you look at the top line, E12 education, that's the largest portion of our state general fund budget. Our estimate is that in 2024, we'll spend $24.5 billion on education, which is $205 million more than our end of session estimates. As always, there are a lot of moving pieces in the education forecast, but this change is driven by two primary factors. First, pupil projections are about a half a percent higher than end of session estimates. And this is because school districts are seeing an increase in the number of recently arrived English learners, which is now factored into our data. In addition, we're seeing higher than projected spending on school meals. Our estimates now incorporate more recent data on the actual participation in the new free school meals program, and also factors in updated information about the cost of those meals. These trends continue into the next biennium, where we project $112 million in higher spending relative to end of session. However, they're moderated somewhat by decreases in compensatory aid and special education. Moving to the next line, Health and Human Services, you'll see this is the largest driver of changes in the spending forecast, with $495 million in higher spending projected in this forecast than previous estimates. In the current biennium, $564 million in the planning years. There are a few things going on in Health and Human Services. The largest is driven by an increase in our costs associated with long-term care waivers. The value of that is about $355 million in the current biennium and over $500 million in the planning years. We have seen increases in both the number of people being served through these programs, as well as the average cost per person. And I'll get more into the enrollment forecast on a later slide. In addition to those changes, the state expects a lower federal share for medical assistance than we previously projected. And this is simply because the state's baseline federal matching rate is lower than we previously forecast. We projected to decline from 51.49% to 51.16%. This reduction is due to Minnesota's per capita income growing faster than national per capita income, which is what drives the federal matching rate. HHS spending is also higher in the first biennium only due to some temporary coverage extensions that were made to households as a part of the COVID public health emergency unwind. The Department of Human Services is in the process of undoing a number of coverage requirements during the public COVID COVID public health emergency. And among their strategies are things to ensure that our coverage isn't terminated in places where people should have maintained coverage due to federal compliance. These increases are offset partially by lower projected enrollment in some eligibility categories. The next line, property tax aids and credits, you can see is $163 million higher in the current biennium and $145 million above previous estimates in the next biennium. This is largely due to higher homestead and renters credit refunds, but in the planning years, we're also projecting increases in the school building bond agricultural credit as a result of higher agricultural land values and school debt service levies. On the next line, state debt service spending is forecast to be lower than previous estimates, due primarily to a smaller than expected bond sale in 2023. On the next line, all other areas of the state budget are also up in both biennia, but for different reasons. In the first biennium, we project $174 million change, and this is simply because there are agencies who carried forward money from last year into the current biennium, and we now project them to spend it in 2024 or 2025. These changes are actually neutral to the general fund, and if you factored those out, the total spending increase would be closer to $800 million. But looking in the planning years where we see $112 million in higher spending in this all other line, that's due to the fact that the forecast is now picking up forecasted increase in the Metro Mobility Program. In 2019, the legislature passed a law saying that in 2026, Metro Mobility would move from a direct appropriated program to more of a forecast program, which means that instead of their appropriations being set at a steady level, they can change as program participation or costs grow. This is the first time those costs are recognized in one of our forecasts. And the final line I'll talk about is the estimated inflation line. This is something the commissioner hinted to earlier. The legislature in February of this year enacted a law directing MMB to include inflation in our budget forecasts. We project the value of that inflation at $880 million in the planning years, which is a $63 million increase from our end of session estimates. The increase is driven by changes in sort of the size of the state budget as well as projected inflation in the planning years. This number represents the cost of funding current services at current levels in wake of rising cost pressures. We sometimes refer to the figure as discretionary inflation because we're only calculating it for programs or funding formulas don't already include factors to adjust for changing prices. However, policymakers get to decide whether or not to actually appropriate this $880 million for these purposes. So now I'm going to talk a little bit more about what's going on in Health and Human Services, specifically around enrollment in our disability waivers. Disability waivers are a collection of services through medical assistance for people with disabilities, both children and adults, who need a level of care that would normally be provided in a nursing home, but choose to receive supports in their homes and communities. They serve people with a wide range of physical and developmental disabilities, brain injuries, and serious mental health needs. This chart illustrates enrollment in these programs over time and compared to our end of session estimates. In this forecast, caseload projections for disability waivers increased 2.1% in the current biennium and 3.2% in the next relative to our end of session estimate. This change drives a $165 million increase in the current biennium and $320 million in the tails. The increase from the previous forecast is driven by updated data, where we're seeing enrollment coming in higher than expected, and the expectation that growth will continue at a higher rate. You can see from this chart that increases in enrollment are not a new trend in these programs. Growth rates were relatively flat from 2010 to 2016 because of legislative enrollment caps that limited the number of new participants. During that time, there were wait lists for the programs because demand for services exceeded the number of new enrollees allowed. But between 2010 and 2023, the average monthly caseload has more than doubled from about 31,000 to 63,000. And that's due in part to in 2016, these legislative enrollment limits expired. Since then, monthly enrollment has grown by an average of 6% per year. Our forecast projects it to continue growing by an average of 4% per year from 2024 through 2027. I'd like to spend a minute looking at our annual spending levels to explain what's going on from biennium to biennium. As I mentioned, we project spending to decline from the current biennium to the next. And generally, state spending grows as the cost of providing services increases. But the decline is the result of significant one-time spending in the 2023 legislative session. Going into last year's budget setting session, there was a $17.5 billion surplus. However, only about a third of that represented ongoing resources, with the rest representing one-time revenues. The enacted budget contained many of these one-time uses in order to align with the available resources. In the chart, you can see the projected spending by year, and you can see that spending is declining significantly from 2024 to 2025, and even a slight decline from 2025 to 2026. Our estimate at the end of session was that approximately $9 billion of last session's appropriations in the current biennium were one time and did not continue into the planning years. That included things like general fund cash for capital investment, housing, transportation, pensions, many other investments. And that $9 billion doesn't include one-time revenue reductions, such as one-time tax rebates. The chart provides useful context to explain what's going on in the state budget from biennium to biennium, but it's also a valuable example of how budgetary choices can attempt to align commitments with our available resources. And with that, I will turn it back to Commissioner Campbell.
All right, just a couple more slides here and then we'll get to questions. This next slide shows the long-term budget outlook. When we think of the state's long-term budget outlook, we compare our forecast revenues against our projected spending for the current biennium and the next. That view is what we call our structural balance. However, the story about the out years is a little bit more complex in this forecast. As we showed earlier in our presentation, that's because of the impact of our record surplus from the previous biennium on the remaining balance at the end of FY27. On this slide, you can see that in both biennia, projected spending is set to outpace forecast revenues. In FY24-25, spending is at $70.5 billion compared to $59.7 billion in incoming revenues. Then, when looking at the structural balance in FY26 and 27, we're comparing $66.2 billion in expenditures to $63.9 billion in forecast revenues. Yet, because of the substantial surplus, we will end FY24-25 with $2.4 billion on the bottom line, assuming that balance is unspent. This amount carries forward into FY26-27. $2.3 billion in higher spending compared to our revenues in the out years means that we have an ongoing structural imbalance. The one-time surplus helps us end FY26-27 with $82 million as our remaining balance on the bottom line. Again, there's positive news in this forecast. Revenues are expected to grow, but having said that, with increasing spending, it appears policymakers should exercise caution when making budget decisions. This final chart illustrates the growth in our general fund budget reserve over the past decade. Since 2014, Minnesota has had a budget reserve target that's based on an annual analysis of revenue volatility. State law directs 33% of the November forecast balance to the reserve until the target is met. Our current target is 4.9% of general fund revenues in the current biennium. As you can see, our total cash flow and reserve amounts combined were about $1 billion in 2012 and now stand at nearly $3 billion, which includes the additional $61 million added to the reserve this forecast. As a result of our improved general fund balance, we were able to allocate that additional fund to the reserve, and that achieves our statutory target under what is a nation-leading budget reserve policy. Some of you may recall that it wasn't too long ago during the Great Recession that our reserve balance was at zero. Policymakers at the time had the foresight to ensure that even as our state saw steady economic improvement, that we were still allocating money to the reserve each November. In 2019, we hit our reserve target for the first time ever and have maintained a reserve at the target since that time. Having a substantial reserve is critical, not only because it is an important element of Minnesota's preparation in the event of an unexpected economic downturn, but it is also a key credit factor that rating agencies have used to award Minnesota's AAA credit rating from all three agencies. Rating agencies want to be sure that the state can weather an economic downturn. A full rainy day fund is a strong indicator. This is key to maintaining our high bond ratings, which lower the state's cost to finance capital projects. In summary, the outlook for this forecast period has a little bit of everything. The outlook for the U.S. economy has improved since the prior forecast. Consumer spending is up, and corporate profits are also up. These improvements point to steadiness on one side of the ledger. However, with rising costs of critical programs like services to Minnesotans with disabilities, school-age children, the elderly, and others, it's increasingly important that we're mindful of our most important priorities when setting budgets. As a reminder, we are on strong footing. Our sound fiscal policy and planning has led to achieving our largest budget reserve to date, which is evidence of strong fiscal management. It's important that we maintain that strong fiscal management going forward. Ultimately, forecasts are intended to help inform the decisions of policymakers. Resources available last legislative session allowed for major investments, many of which were one-time in nature, in recognition that spending needed to be in line with resources. The update that we're providing today is that while we expect to end both biennia in our forecast period with a balance, the underlying structural imbalance is something we need to continue to monitor and be mindful of as we make budget decisions during the next legislative session and beyond. This will keep our state on sound fiscal footing and help maintain excellent financial management so that we can deliver on our commitments to Minnesotans. And with that, I'm happy to take your questions.
Go to slide 17 and walk us through those numbers. Yeah. So I come down to the bottom of 24-25 and I have 2.392 remaining balance. It then flows into the next biennium, correct?
If unspent.
If unspent.
Yes.
Big caveat, yes. So how do you get to 56-55? What makes up the rest of that beginning balance number?
Ahna, is that a question that you can answer?
The 5655 is the combination of the remaining balance and the budget reserve and cash flow accounts. So just the nature of our financial statements is we add the reserve is part of what flows in at the beginning of the biennium, and then we subtract it out on the table. It's
2392 plus 3263 better equal 5655, correct?
yes, it should be better. It does.
Commissioner, can you talk a little bit more about the causes behind that projected deficit? Can you detail that for us?
Well, let me clarify that we're not projecting a deficit. We're projecting a structural imbalance, and
Call that a deficit?
correct. It is, sorry, it is not fair to call it a deficit. We have a positive balance at the end of each biennium. What we have is structural imbalance because our spending is exceeding our revenues. The distinction is because we have had surpluses that have carried over from biennia to biennium, and that is sort of blunting that impact.
Can you talk about the source, though, of the declining revenues then and the imbalance?
So we've talked through the increase in spending. So the spending, the largest single driver there is the disability waivers, amongst other things, as Ahna outlined. And then, Dr. Kalambokidis, do you want to say anything about more about the revenues than what you've already indicated?
So revenues aren't declining biennium to biennium. We've added, and they're growing, and we've added money to our forecast for the current biennium. And then the second biennium is roughly flat. We've taken 30 million out. So it's just that the structural imbalance is the difference between the revenues and spending in this chart.
Fair to say that increased costs, you talked about education being a driver. Is it increased cost of the free meals? Is it more participation, the food costs more? Can you talk a little bit more about that?
It's both of those things as it relates to meals, and that is one part of the story. There are several different things that are ultimately driving the increase in spending. So one of them is the number of pupils, English language learners. Meals, as we discussed, that's both a result of the cost of the food and the number of pupils who are participating. As we talked about, we also are seeing increases in spending in HHS, including disability waivers, the Medicaid match, federal match, amongst other things.
How does it, English learners, how does that impact the education spending?
Yeah, on a question. Ahna, can you help us?
So the English learners are just contribute to a higher pupil projection. So if you think most of our education forecast is based on how many kids are in our schools, and then what is the cost of educating them. And so we're projecting a 0.5% increase in pupils across the forecast horizon. And the largest driver is that we are seeing data that indicate there are more English language learners than we previously assumed. Does that answer your question?
Can we return to the difference between a structural balance and an actual imbalance and an actual deficit? Help us explain that to ordinary readers. What's the difference?
The difference is that you have a remaining balance from in this case, the difference is that we have a positive balance at the end of the previous fiscal years that's rolling over. And that is allowing us to maintain those spending levels without reaching a deficit.
Based on the trends we see here in this forecast for spending and for revenue, what other than spending cuts could actually prevent this imbalance going in 26, 27, and going forward, even that could become an actual deficit the way you define it?
Well, it's important to note that we're just a few months into this particular biennium, so a lot could change over the course of the next 19 months. There are any number of factors. Ultimately, revenues could increase. Some of the spending numbers could come down. We'll know more in the February forecast in terms of how those things are shaping out as we're further into the fiscal year.
How much more is the school lunches costing so far, and how much higher is participation? It's supposed to be a little under $400 million the first biennium. Do you know? It's only the first half of the school year, but do you know so far?
We do have that number.
Yeah.
Just 1 second.
So school meals costing about, let me get the actual number. So it's an increase about, and I'm going to find this for you, about $85 million this biennium, and about 81 million this biennium, and $95 million in the tails.
That's a projection based on how many kids are taking the lunches so far compared to what you thought.
And that's an increase over the initial estimate that the legislature accounted for in their spending. So it's $80-some million over that 300 something it was.
That's right. And so it's both the participation increases, which are based on really preliminary and partial data. And then also we're basing the reimbursement the state is providing to school districts on USDA reimbursement levels. And those have gone up since last session. So we're sort of now better factoring in their sort of future growth over time, recognizing that they're sort of indexed to inflation and that this forecast needs to account for that as well.
There's no cost benefit analysis yet, though, to show what the positive effect of kids eating is, right?
I think that's one of a number of policies enacted last session where the actual effects aren't factored into the forecast.
Talk to me. Remember in July, Commissioner Marquardt talked about this error in the taxes bill, $352 million. How is that accounted for here, since it would take a statutory change and you have to work off current law? Is that in here yet?
That is not factored in. That's a good question. It's not factored in. It's not factored in because the error was discovered after the end of the legislative session. It was not what was intended, and so legislative leaders and tax chairs sent a letter indicating that they plan to fix that early in the legislative session. And so understanding that, we've not included that $350 million in each fiscal year in these estimates.
Not backed it
We
out.
have not. It is not included. The $350 million is not included. That would be an increase in revenue, and that is not shown.
Commissioner, sorry to belabor the point, but are you saying that if the legislature spends more than $82 million in ongoing spending, that could force a deficit?
So keeping in mind that there's $880 million accounted for in inflation, which is like that money is not appropriated yet. That's discretionary inflation, and it reflects what would need to be appropriated in order to maintain current service levels. What I would say is that if whatever is spent this legislative session does have an impact on that $82 million on the bottom right-hand side of that chart, it'll drive down.
If I can follow up too, Commissioner, and I know you don't want to get into the politics in this, but we already have multiple press releases of legislative leaders calling this a Democrat deficit. Is that inaccurate?
I would not say that that's accurate. I think what you have here is we've got costs that are being driven by programs that have been around a very long time. Caps that came off in 2016 on those disability waivers. What we're seeing is a change in the economy is, what we know is that we actually have more stability than we've had in the past. There's less volatility, and we just have more constraint in our budget than we have had previously.
And once upon a time, we wouldn't have referred to this as a deficit, with or without inflation?
In any case, what we are looking at right now is not considered a deficit.
Aren't all the signs pointing to if spending isn't curtailed, they don't carry over the balance, that a deficit could happen? Whether the numbers here, a structural imbalance, deficit, that terminology aside, that if spending continues at this rate, could a deficit happen in the future?
Sure, a deficit is possible in the future, and that depends on what happens this legislative session, and it depends on whether or not our projected spending continues at the same rate, if it's higher, if it's lower. It depends on whether or not our revenues come in as projected, higher or lower. So there are a number of different things that are ultimately driving that factor. But certainly, one outcome could be a deficit.
In a similar vein, would you or would you not attribute the potential structural imbalance to spending from the previous session?
I would not. There are some of the drivers come from decisions that were made last legislative session, but that's just a part of the story.
But you just said that, the school meals is an example of something that was passed last session.
Right, that's why I said it's a part of the story, but it's not the whole story.
That's like $80 million, and you're talking about $80 million. That's what it's on the bottom line right now. So that would double it would be more than $400 million, but yeah.
So as you can see, the increased spending is projected to be $998 million.
I'm sorry, go ahead.
But no, I was just saying I was talking about the other slide.
Why did you have a lower bond sale than projected? Was that just market, or? And will that come in the next bond? Will you grab that value back in the next bond sale?
The reason is we issue bonds based on our projections for spending needs. So we talk to projects where the legislature has authorized them. And then say, are you ready? Are you ready to spend the money now? So we don't issue more bonds than we really need. And what we learned this summer is there were fewer needs. So agencies and local governments didn't need the cash at the moment. And so we issued just over $400 million less bonds than the forecast assumed. But to your second question, yes, we do then project our next bond sale will be bigger as we sort of play catch up.
So it wasn't a factor that the rates were so high, you decided not to sell as many in hopes that the rates would come down. You got what you needed out of that bond sale.
Yeah, it's purely as a result of cash flow analysis of the currently authorized projects, and then the fact that there wasn't a 2022 bonding bill.
Speaking of bonding bill debt capacity for another bonding bill, what's safe? What's there and what's safe?
What we are assuming in this forecast is $830 million for a bonding bill. That's in general obligation bonds, trunk highway funds. That is a little bit lower than you might be accustomed to at 880. That's been the 10-year average. The reason that's a little bit lower is because we're getting closer to one of our debt guidelines. We have 3 debt guidelines. It's number 3 that we are approaching. And so we have adjusted the number in the forecast to reflect what we could actually bond for to stay within that guideline.
The caution you were urging, is it also caution in bonding too, not just budgeting in the coming session?
Yes.
Is there an underlying reason that disability waivers are expected to rise? Forgive me if I missed that at all.
The answer is complicated, and I think it's something that we have to understand better. I mean, at the end of the day, there are more people who are in the program, and I think that is, I don't know if Ahna would like to say anything further about that, but there could be many factors, including determinations being made at a county level in terms of, who qualifies for what program.
National trends too, or is Minnesota an outlier?
I can't speak to how our disability waiver spending compares to other states, but I do want to just remind folks of this chart that shows the trend in disability waiver enrollment, and clearly the enrollment is part of the story, also average cost. So we saw an increase in enrollment relative to end of session, but also we've seen a significant increase over time, almost doubling from 2010 to more than doubling from 2010 to 2023. And if you see the relatively flat line from 2010 to 2015, that was a time when we had legislative enrollment caps, so that we had wait lists because there were more people who wanted to access the service than the law allowed. Since that time, since the end of these enrollment limits, enrollment has grown fairly quickly, and we expect at some point for that to level off, but it has not happened, hasn't happened yet.
Really quickly, I was looking at my notes from the February forecast, and former Commissioner Showalter said that there was an expectation that structurally revenues, or at least at that point in time, that structurally revenues would exceed spending. I'm wondering, what did anything change in the calculation that would cause it to swing this way, or is it just simply that for all the numbers we just mentioned, that spending exceeded what they had projected in a significant enough way to swing it that way?
I would say it's the latter.
If we can go back to 17 one more time, please. The question is, if revenues if revenues were expected to exceed spending, wouldn't you call it a projected surplus?
We do have a projected surplus in 24-25.
Okay.
I'm happy to talk to you afterwards to try to answer your questions.
But in 26-27, you would call it a positive structural balance. You would not call it a surplus in that out budget because the budget has not been drafted. That's right.
Yeah, we would say we're in balance, that we are in balance if that were the case. We would not have that we do, Peter has praised it correctly. So what we would say is that we have a positive structural balance if that were to be the case.
And a real deficit is still illegal, correct?
Sorry?
An actual deficit is illegal.
Is illegal?
Illegal.
No, it's not legal. You can't have an actual deficit here.
Yeah, we would, yes, in a current biennium, we would not be able to do that. So, see that the governor is here, so thank you for your time.